Zomato has just completed a year as a public and listed company. It's probably the most spoken about and scrutinized company that's IPO'd in India. And there are many reasons for this. Of course, the fact that it raised a lot of private capital before going public, it's unprofitable, and also the fact that it's a very new age D2C business without a parallel that exists. But today, we take a look at exactly why Zomato's success is super important for the Indian startup ecosystem as a whole. Now, before we begin, don't forget to like and subscribe to our channel. One of the reasons it's imperative for Zomato to succeed is because Zomato remains the flag bearer of the Indian startup ecosystem from a digital economy perspective. Now, there have been many digital companies that have IPO'd in the past, but these have either been not at that very high valuation because they didn't raise that much private capital, they became profitable, or they have not attained that level of scale. Therefore, Zomato is the first new age company at the level of scale that it has achieved to actually go to the public markets. And now, why is it important for a digital company like Zomato to succeed? Because it very clearly shows the potential of the entire digital economy in India. If you look at India as a country, we have more than 1.3 billion people. Now, this, by the way, is much, much more than US's 300 or the United States 300 million people. Literally a fourth of the Indian population the United States has. Now, out of these 1.3 billion people, over 800 million people have actually got access to data connectivity, which is by far one of the largest economies to have gotten digitized in the world. India is also the second fastest digitizing nation, and this goes to show that many people believe or have adopted to the digital economy for buying, selling, networking, or any other form of commerce. Out of this entire 800 million set, it's expected that over the course of the next decade, 100 million jobs will actually be created in the digital economy. Now, the companies responsible for creation of these jobs are typically startups that achieve a level of scale. Zomato, for instance, already employs about 319,000 delivery boys as gig workers. Zomato is therefore not just another company which went public, but a company which really is testament to India's digital economy over the next decade or two. Now, another reason why Zomato's success is imperative for Indian startups is because the Indian stock market, as far as technology companies or technology IPOs are concerned, is quite nascent. And that's why it's got so many eyeballs, all the IPOs that have happened. Essentially because Indians or India has not seen startups list, unlike the USA, where large companies are tech companies or where the largest companies are tech companies. You have the likes of Apple, you have Google, you've got Meta or Facebook, so on and so forth. Now, these companies are the most profitable and the largest companies across the world. And that's why the entire technology public market in the US has been successful. So much so that, in fact, there is a special index just for technology companies called the NASDAQ. India has only the Sensex and Nifty, which is a mixture of all kinds of companies and not just tech companies. And this is the kind of focus that the US has given, primarily because startups have proven themselves. Now, one of the reasons for this is the fact that startups in the US are also extremely profitable. They profit in billions of dollars on a quarterly basis, primarily because they have attained that level of scale and customers have the kind of trust that they do and are willing to pay for the services. In India, startups are yet to attain that level of profitability, and hence it is difficult from a public market investor's lens to really determine the valuation of a particular company. Historically, the stock market goes by very simple metrics of price to earning ratios and a discounted cash flow, which basically tells a prospective investor about a company's future earning potential and thereby its future prospective valuation. However, given the fact that Zomato is a loss making company, the price to earning ratio does not hold, and neither does the discounted cash flow. And coming to the right valuation for the company, therefore, becomes very difficult for traditional retail investors or even institutions that have not seen such businesses before. If Zomato is able to justify its business model and, of course, the valuation, it leaves the ground open for many, many Indian startups to IPO in the near future, as investor appetite for tech startups would have been bit. Now, it's well known that Zomato is a loss making B2C company. B2C would, in this case, mean business to consumer. And B2C businesses in India, in particular, are a very, very tough category to become profitable in. There are a couple of reasons for this. One of the reasons is the fact that India is a low ARPU nation. ARPU is average revenue per unit, which basically means for every consumer, how much money do you actually earn? Low ARPU businesses have a tough time making profits. Another reason that D2C businesses are generally difficult in India are because consumers don't pay for delivery, which means that fees are negligible. In the case of Zomato, they charge a delivery fee. And if you look at parallels across India and a developed economy like the US, you'll find that in the US, even for something like an Amazon Prime, consumers are willing to pay $5 or about 400 rupees on a monthly basis. In India, consumers are not willing to pay more than $12 or about 1,000 rupees on an annual basis. This means that getting consumers to pay convenience fees like delivery fees, convenience fees, service charges is very, very tough, thereby automatically reducing one key source of revenue. Another reason why B2C businesses find it tough in India is because India's per capita income is significantly low. Now, per capita income is the income of one person on an annualized basis. India has about a per capita income of 2,000 or 2,200 odd dollars, which makes it even lower than that of Bangladesh. Now, if people don't have a good enough earning, they would automatically not have the mindset which requires them to pay for additional services and conveniences. The D2C business or the B2C business in India is typically a small margin business, which comes from the fact that the ARPU is low and thereby the margins are also squeezed. So you have to find a way of making money with very, very small margins. Additionally, food delivery in India is a very competitive industry. And of course, the largest competitor of Zomato is a company called Swiggy, which most of us would know of. Now, Swiggy is a privately held company which has raised a lot of capital, and therefore the competition between the two companies is quite intense. Now, these are the 4 or 5 reasons why making a loss making B2C company in India actually profitable and successful can pose quite a few challenges. But however, if Zomato is able to overcome these challenges, and as per its numbers, that does not seem too far, we must remember that Zomato actually caters to a market size of over 1.3 billion people across the country. The median age is actually about 29 years, which makes that most of the people who would be ordering on the platform are technology savvy millennials and Gen Zs. Now, this makes the market size significantly large. And with currently only about 17 million customers on their platform, there seems to be a very, very large white space open for Zomato to actually grow their business. So once the company has able to maintain their unit economics, prove their business model, the market size to grow and become a very, very large company is quite significant. The fourth point is that Zomato is actually, or seems like, it's walking the talk in terms of numbers. If you look at the latest quarterly numbers in the first quarter of this financial year, Zomato actually attained revenues of over $230 million. This is about 15 to 20% growth over the last quarter's number, and the loss is only $20 million. Now, the reason that we say it's only $20 million is because historically, Zomato's loss, especially about 2 to 3 years back, was $20 million on a monthly business. Additionally, the food delivery business recorded revenues of about $200 million. And for the first time in Zomato's history, the business actually broke even or is almost profitable, We do expect Zomato's food delivery business to become profitable over the coming quarters. In addition to better unit economics, Zomato has also attained significant scale with about 10 to 15% growth across different metrics. If you look at the users, Zomato currently has about 17 odd million monthly users who order from the platform at least once. The delivery boys on or delivery women on Zomato's platform have increased to about 319,000, and the restaurant partners to about 208,000. In addition to these numbers, Zomato also has its B2B business of Hyperpure, other businesses like advertising and dining out, which is about $10 million in revenue, Blinkit, which was recently acquired from a quick commerce perspective, and some other businesses and investments like Shiprocket and many others. In addition to the above numbers, Zomato also has cash in its bank of about $1.2 billion. Now, one of the reasons that startups are able to scale and become very large companies in a short span of time is because they raise money from institutional investors called VCs. VCs or venture capitalists are investors who invest in companies that have the potential to grow at a very fast pace, thereby giving them high returns on their capital invested. Before we dive into this, let's quickly understand how a typical VC model works. Now, VCs typically raise money from their investors called LPs. LPs or limited partners could be very large family offices, rich individuals, large endowments, funds, schools, colleges, etc., who have a lot of cash lying with them which they need to invest. And some part of that cash is invested in high risk categories like startups, wherein they could get a higher return on their capital invested. Now, VCs raise this capital from LPs, invest these across startups, and these startups, once they grow fast, become successful, are able to provide an exit to the VC, who then returns their money to the LP, keeping a share of the profits. Now, for this entire model to succeed, which means for startups to raise more money, VCs need to raise more money from LPs, for which they need to return money that they have previously raised with significant amounts of profits. Now, Zomato, before it actually went public, raised about $2.1 billion from such VCs. Now, this $2.1 billion, once the company has gone for an IPO based on certain terms and conditions, will be returned to these VCs, and therefore, once this money is returned, they will be able to invest more money across different companies. In fact, the exit of Flipkart to Walmart made VC investments quite hot across the Indian ecosystem. When startups become successful, they also lead to more startups. So companies like Udan, PhonePe have actually been started by ex-employees of companies like Flipkart, Zomato, Ola, Byju's, so on and so forth. These are actually called startup mafias. So why we need investors to become successful and to actually get their capital back with profits is so that they can continue infusing more money into Indian startups, and thereby Zomato's success becomes all the more imperative for startups in India. Now, one of the reasons that startups scale very fast and actually create an impact for the entire country they operate in is because they function in many cases like a marketplace and not a full stack fixed assets based business model like a factory or like a restaurant. Zomato, for that matter, or a marketplace for that matter, basically has a couple of key advantages. Before, let's understand what a marketplace really is in the case of Zomato. So, Zomato acts as a platform which, on one side, has its customers. These are individuals like us who place their orders and who are now, of latest count, to the tune of 1.7 million people. On the other side, Zomato actually has its restaurants, which are now about 208,000. Now, these restaurants are connected to their consumers through Zomato, and the delivery is facilitated through their own delivery channel, which is now to the tune of 319,000 delivery personnel. Now, in this case, Zomato does not own any of the restaurants. It does not employ on a full-time basis the delivery boys, and it does not, of course, have ownership over consumers. However, it connects all three, thereby creating a marketplace. A marketplace has a couple of key advantages. One is the fact that there is no capex involved, which means they don't have to buy land, plant, machinery, The other is the fact that it's a low margin business. And why is this an advantage? Because many businesses which are working with a margin don't have to, with a marketplace, don't have to sacrifice their margins in order to list on a marketplace. Through a marketplace, a business can also attain significant scale because you're not spending time building out a restaurant or a factory. You're simply connecting an existing infrastructure. It also comes and has low costs because it effectively reduces low cost for the consumers because it effectively reduces all middlemen from the business who take significantly high commissions. Now, this is one of the reasons why Zomato's success becomes very important for India, because it is not just Zomato's success, it's actually the success of the entire marketplace model. The marketplace model also has an importance as far as the gig economy is concerned. The gig economy or the part-time economy is essentially an economy which works on the basis of micro entrepreneurs like your Ola and Uber cab drivers. Now, these cab drivers don't technically have a full time job and they work as micro entrepreneurs with the platform. Zomato's success thereby means the success of a marketplace model and hence the success of the gig economy. Another reason why Zomato's success implies success of the entire startup ecosystem is because Zomato has always been a company focused on capitalism with a conscience. Ethics and corporate social responsibility have been a key pillar of the company's history, and there are a couple of very clear signs of this. One of the factors that gives confidence in Zomato's entire business model and its functioning as a marketplace is the fact that it truly works as a marketplace model, which means that it does not have any cloud kitchens which are owned by Zomato, any restaurants which have ownership or shareholding of Zomato, and it doesn't even have private labels which basically compete with food from other restaurants. This makes it an entirely fair marketplace. Zomato also has an initiative called Feeding India Initiative, which is a non-profit that delivers meals to Indians. Feeding India delivers about 200,000 meals on a daily basis. In addition to Feeding India, Zomato has always been a proponent of diversity at the workplace. And Zomato's board today actually consists of 50% female board members. 40% of their top 25 employees at the company are also female. Many other such initiatives make Zomato a company focused on ethics, capitalism with a conscience, and the right kind of CSR. The success of Zomato is not the success of just one company. It bodes well for middle class India in general. If you look across India's history, you will find that prosperity and wealth has been mostly limited to wealthy families or people with means, and the rest to stable jobs and live a savings oriented lifestyle. However, for more Indians to succeed, middle class India, aspirational India, needs to participate in the true success stories of the country. If you look at Zomato, it's been nothing short of a marathon and a hustle. Starting off as a company that scanned menu known as Foodie Bay in 2008 2009, and then eventually going to delivering food and other products by building their own logistics network and raising $2.1 billion in venture capital money, leading up to a $12 billion IPO. Zomato is truly an inspirational story. Success breeds more success. That Zomato's success clears the way for many, many more startups to come. Thanks again for watching.